Just explain it like I'm 5.
Welcome back to the EX5 podcast, Explain It Like I'm 5 in long form. Today we have on a very special guest, and I'm going to go ahead and let you do an intro for
Oh,
yourself.
okay. My name is Victoria Wikiera. I'm a CPA. I've been focusing on individual and small business income taxes for about 10 years. I've spent part of that time running my own small practice. That's what I do currently. And part of that time working at a nationally recognized wealth management firm and performing tax planning and compliance for clients of that firm.
Well, the reason why I have you on this show is to talk about a topic that I think we speak a lot about, but nobody really explains, and that's taxes.
Yeah.
So, EX5, Explain It Like I'm 5, taxes. And so, I got a handful of questions for you here that I'd love for you to explain it like I'm 5 to the rest of the world, if you don't mind.
I would be thrilled.
Well, take us back. Let's start. Take us back in history. Okay.
Okay.
So let's go before there was an IRS, before there was an American income tax system. Why do we have income taxes now? And did we always have them?
We didn't always have them, but there's always some form of taxation. It's kind of a necessary evil of having a government, right? I mean, it takes money to operate a government. Taxes is how that's usually performed, and it can take place in all different kinds of ways. Think back to like Robin Hood movies and stuff when the little peasants are getting taxed to death by the evil king. I mean, there's always taxes, right? So we do have an income-based tax system in the U.S., and we haven't always had it. They first implemented it during the Civil War in order to raise funds for the war. Abraham Lincoln implemented an income tax.
Hmm.
It didn't stick around. They decided it was unconstitutional for some reason, something having to do with the population of the states not being taken into account because, back in those days, some states had like 5 people and some
Right.
states had a lot more. So they were trying to make that equal. So they decided it was unconstitutional. It was revoked. They tried to put it back in a couple of times. It kept getting revoked. Around turn of the century, early 1900s, they added an amendment to the Constitution allowing them to perform an income tax without taking into account the population of the states. So basically, since then, we've had an income tax in the U.S. that we've been paying ever since.
So now we're sitting in the world where we are today. Just how much money goes to the government for income taxes, the federal government?
I don't know a dollar amount necessarily that they receive each year, but individual income taxes in general, meaning the income taxes you and I pay, the income taxes that maybe a corporation might pay, and our payroll taxes, which we can dive into a little more detailed later, that makes up about 80% of our government's annual income.
Wow.
So it's a huge, huge chunk of the revenue that the government receives is from our tax dollars. And most of that, 80%, is, like I said, it's our individual income taxes that you and I are paying on our 1040s and the payroll taxes that are coming out of our paychecks. Those two components make up the largest portion of that number by far.
And do you have an idea of, okay, so if we've got 100% pie and 80% of it is income taxes, where's our money go? Is it a good cause
What do we do with
here?
the tax money?
Yeah, what happens with the tax money?
At the federal level, and states are different. States could take in a lot of other things into account, but at the federal level, what most of that money is going towards, programs like Social Security and Medicare.
Okay.
A lot of it goes towards defense and military and security, just national security issues. And a lot of it also goes towards paying the interest on our national deficit, which is upwards of 14 trillion. And in 2018, the interest payment on that deficit is about $310 billion. So $310 billion that our government's paying this year alone to keep that debt rolling.
So in overall size, are we talking about hundreds of billions of dollars? Or are we talking about trillions of dollars in annual revenue that
annual
comes
revenues?
in? Yeah.
I'm really not sure. I'd have to look it up. Probably high billions, I'm guessing.
Okay. So just how big is the IRS? When we think about it, we think of this as elusive kind of like person behind the veil, but we have like really no idea even one where they reside or just how big they are.
they're actually, when you take into consideration how big their job is and how many returns they have to process, and not only process, but maybe audit or do whatever investigation work needs to be done. That's hundreds of millions of tax returns that get filed every year. They have 80,000 employees in total,
Okay.
and their funding has been cut drastically in the last 5 to 10 years. I think they've lost maybe 20% of their budget.
Wow.
So they're incredibly understaffed. They're incredibly behind on technology. If I want to communicate with the IRS, I have to send them a fax. That is the
Faxes still exist.
faxes still exist. So they don't have a lot of resources. They're massively unprepared for the job they have, which is huge.
So let's talk some semantics here. How does the government get paid if I'm an employee? So
Yeah.
I work for a company. Somehow money makes its way to the federal government. How does that happen?
So there's several things that come out of your check if you're an employee getting a paycheck and you receive a W-2 at the end of the year. You work for somebody else, right? You're not self-employed. We've all gotten used to getting those pay stubs and we see the gross amount and it sounds so nice and it's so much higher than what actually went into our bank account. A lot of what's coming out, the first thing that's coming out is your withholding. So some of the money's coming out to pay your tax bill and is, somewhat to your benefit. The rest of those things that get taken out, you don't really see coming back to you. And that really consists of FICA, which is Social Security and Medicare taxes that everyone's required to pay. And
What's FICA stand for?
oh gosh, now you're asking me to remember an anagram. Federal Income something something Commission Act. I don't know.
Close.
Is that it?
The Federal Insurance Contributions Act.
There we go.
Okay.
See?
There we go.
So there's two sides to it. You as the employee pay half of those items.
Okay.
Your employer also pays the other half of those items. In total, this amount that's being paid by you and the employer going towards FICA, Social Security, and Medicare is about 15%. And as the employee, you're paying about 7.5% of that. And some of the items get capped out at a certain dollar amount that you've earned. For example, they stop, taking Social Security out around $128,000 of income, something like that. So every dollar over that you make, you're not paying Social Security on if you're fortunate enough to make that much money. Medicare, however, there's no cap. And in fact, if you make enough money, between $200,000 and $300,000, and depending on your filing status, you actually pay an additional Medicare tax of 0.09%.
So you're an employee. Let's say I make an even $100,000.
Mhm.
The paycheck magically shows up in my bank account. What's happening behind the scenes? So the business has money. They're paying an employee, and the amount that hits your bank account already has taxes taken out, or what happens
Correct.
behind the scenes?
Correct. You only receive the net amount. So they're going to take out not only your tax withholding and not only those payroll taxes that you're obligated to pay, they're also maybe going to take out whatever benefits you may be receiving from the company, whether it's 401k contributions or health insurance or life insurance or all the other kind of things you can sometimes sign up for if you're a full-time employee. And they just give you what's left. They give you the net amount at the end of the day after all of those items have been taken out. So what you get in your bank account is post all of those deductions.
And then how's the government getting paid, and when are they getting paid? Is that the role of the business to then send checks to them monthly,
Correct.
quarterly, yearly,
Correct.
or?
It depends on the size of the business and how many employees they have, honestly, how
Okay.
often they're required to pay in. Usually it's at least quarterly. But it is their obligation, the employer's obligation, to make sure that those withholdings and payroll taxes are getting paid timely, and they do pay them throughout the year. There are deposit requirements, and again, it can be kind of based on the size and volume, how often they have to do that.
So I'm going to put you on the spot here. I've
Sure.
got a sample paycheck.
Okay, I'm ready.
From an anonymous person who has sent this to us. This is, as the only reference, is the state of Missouri.
Okay.
It's a Missouri employee, Missouri resident.
Okay.
So if you can walk us through what you're looking at and what you're deciphering.
Sure. So right up here, kind of near the top of the page where we start getting into the numbers, we see total gross. And there's a figure for hours. Even if you're on a salary, sometimes they put the hours that you've worked on there just for record keeping purposes. So if you're being paid hourly, that's really important. If you're being paid a salary, it's just sort of, they fill it in with whatever they need to fill it in with. The current number here $4,240.43, is the current gross amount of the paycheck.
And what's
So
that mean?
that means it's before they've taken anything out.
Okay.
This is what we wish was hitting our bank account.
So if we
and
took
it's
that
not.
number and multiplied it by 52 or by
Depends how often
26
they
and a
cut
half?
payroll. Yeah,
Okay.
if they're doing it biweekly, then yeah, you'd multiply it times 22, and that should come up, or I'm sorry, 26, and that should come up with your annual salary or pretty close to it.
Okay.
If they're doing bi-monthly or some other weird pay period, you'd have to account for that. But that's the gross number. And then in that next column, we can see they usually provide year-to-date figures. So this anonymous donor of this pay stub has made a little over $89,000 to date on this pay stub. Again, that's gross. That's before anything's come out. Then we see a line here that also, I should say, every pay stub looks different. They're not uniform. They have a lot of the same items on them, but they're all sort of presented differently.
So what you're reading now may not be the exact order of what a listener is going to
Correct.
see,
It could look
but
quite different.
you should be able to see the same type of line items somewhere on the form.
Correct.
Okay.
Correct. So this one has a line for total deductions, this $15,043. That's a combination of everything that they've taken out for whatever category and whatever reason. Below that, we're seeing the total net number, this $2,697 under the current column. That's what hit this person's bank account. Okay, that's what they got after everything. All the taxes came out, all the preferential items came out, whatever benefits came out. And so year to date, we can see that amount is 53,000-ish that's actually been deposited into the bank account that this person actually has to live off of during the year.
So that's an itemization of how you made your money.
Yep,
And
all
where
the
it came
different rates
from.
that you made it, and if it was vacation time, a regular salary, or overtime,
Which
or
it's
what have you.
fully in your power as an employee to look through that, calculate it, and if you feel something's off, is it weird to talk to your employer about it, or
No, always talk to the employer.
okay? Because
Have
there's
a-
laws in place, actually, right? If you have like a set contract for how much you make, and for some reason it doesn't add up,
Oh yeah, and payroll mistakes happen frequently.
yeah.
Payroll is kind of a nightmare to run, especially if it's a larger company. There's a lot of devil in the details. I wouldn't say that it's not rocket science, but it's one of those things where once it gets messed up, it's just a nightmare to correct, and there is just a lot of little tweaking you have to do to it on a regular basis.
And you're dealing with people's income, so there's no
Yeah.
margin for
Yeah.
being wrong.
So yeah, if you think something's wrong with your check, absolutely talk to your employer.
All right.
Typically, they'll be like, "Oh yeah, we messed that up. Here's the correction." So yeah, you should always bring it up. Never feel strange about it.
Great.
So
Now you're on page 2.
Now I'm on page 2, and I'm coming to the taxes section, which is kind of what we were just talking about. So this first line that says federal income tax, that's the withholding. That's the money that's coming out to pay your individual income taxes. You have some control over how much withholding they take out. We've all done that new hire paperwork when you get a job, and you fill out the sheet saying, well, I work, and does my spouse work, and do I have kids, and yada, yada, yada. So you have a little
What's
bit.
that form called?
That form's called a W-4.
And before we go deeper, why do we hear like W-4, 1099? Like, why are these weird names?
Because they name the forms weird names and letters and numbers instead of just calling them what they are.
Right. So it's an identification thing then for the federal government to say form W-2 rather than the withholding tax form of 2019 or whatever that is.
Yes.
Okay.
Yes. And even when you go to prepare a tax return, all the forms have, strange numbers. They're usually 4 digits long, and they kind of have no rhyme or reason to how they got assigned.
Okay. Great.
So that's the first line item. So the $696, that's the withholding that came out this check. And then I can see that year to date, a little over $15,000 has been withheld for income taxes. This next line is the FICA that we talked about that comprises Social Security and Medicare payments. This says FICA employee because, again, half is paid by you, the employee, and half is paid by the employer. So this is just the employee portion of those items. Next, we have the Kansas income tax. So they will withhold for any states that they are sourcing your income to. So if you're, especially, we live in an area where a lot of people work in one state and live in the other. So we have a lot of that kind of situation happening.
So if you live in Kansas but work in Missouri, you face a kind of a double tax situation sometimes.
You have a filing obligation to both states,
Okay.
and you'll pay tax in both states. You don't actually pay the tax twice because you get some amount of credit for the tax you paid to the other state. So let's say I live in Kansas, but I work in Missouri. I am going to file a Missouri tax return that has my Missouri income on it, and I'm going to pay Missouri taxes on that Missouri income. Then when I go file my Kansas return where I live, my resident state of Kansas, I'm going to pay tax on all my income, including that Missouri income, but I will get a credit for whatever I paid to Missouri. So
Okay.
I'm not paying tax on it twice, but what does end up happening is if your resident state has a higher tax rate, you're going to end up paying that higher tax rate on that Missouri income because you're only going to get a credit for the amount you paid to Missouri.
Okay.
And if their tax rate is lower, it's not going to fully compensate for the taxes you would owe in Kansas. Now, Kansas and Missouri actually have really similar tax rates, so it's not that
And
big
is
of a deal.
that a pretty common practice, or is it a matter of what the rules, laws, and regulations are on a state-by-state basis?
It can have some nuance by state, but that's a pretty general rule that
Okay.
applies pretty much everywhere.
Great.
Yeah.
So back to page 2.
So back to page 2. So we have the Kansas withholding. Then we have the Medicare employee has been listed separately here, again, because there's some additional withholdings that have been added to that recently, and depending on income, they might have an additional Medicare withholding requirement. Below that, the Missouri income tax. So this person is working in Kansas and in Missouri. They have to split out where that work is being performed. So the Missouri withholding is this 187. And then we just see a total of all the taxes, income tax withholding and payroll taxes that have come out. And that total is $1,200-ish. So
Okay.
that right off the top of this $4,200, we've already lost $1,200 to taxes. Now, some of that is withholding that we'll get credit for when we file our taxes. The rest of it's just kind of gone.
Okay. Is that something we should be? I mean, I think when you first get into being an employee, you see that and you're like, gotta make no money, right? Because
Right.
you feel like it's all being ripped out from you. But do you feel like we should appreciate the fact that it's not so
Yes.
bad? Like, I mean, when you look at the rest of the world, we do complain about taxes a lot. But you go to, Western European countries and they're a lot higher
Yeah.
than what we experience.
Well, and some of those countries give a lot more benefits to their citizens, and that's really what I think we all know that idealistically our tax dollars are going to go to services and benefits for the citizens of our country, right? Whether that's paving roads or education or, medical research, whatever it may be. And it does go to some of those areas, right? But we also have a creeping feeling that not all of our tax dollars are being spent the way that we would like to have them spent. So that sort of, yeah, it feels a little harsh when a big chunk of your check, is getting taken away, and it feels a little nebulous about where it's going. But the FICA, which makes up Social Security and Medicare and Medicaid, those are really important programs for the people of our country. So you should feel good about supporting those programs and contributing to them. And in theory, you're going to receive some sort of benefit from them in the future, even if it's just collecting your Social Security payments. Now, I know a lot of us think Social Security is not going to be there for us, that it's by the time, you and I are retiring, that it may be defunct or, empty, that there'll be no money left. I actually am optimistic about that and don't feel like it's going to disappear because it's such an easy budget item to fix. So like I mentioned before, Social Security, they stop collecting it on your income once you reach $128,000-ish. Well, they raise that amount a little bit every year. That cap goes up a slight amount every year. But if we were forecasting a major problem with Social Security being underfunded, all we have to do is raise that cap to a point where more is being paid in. For those of us who are doing really well financially and making a ton of income, say you're making millions of dollars a year, you're only contributing to Social Security up to that first $128,000. So if we raise that cap up to even $200,000, that's a ton more coming into Social Security.
So what
each
you're
year.
telling me is, after $28,000 of income,
$128,000.
So after the first $128,000 you make, if you made $129,000, you don't have to pay any more into that
For Social Security.
for Social Security.
Correct.
Okay,
But just Social Security. So
that's odd, right? That's kind
what-
of weird, right?
Well, yeah, it is.
Like, I'm trying to find the logic behind that, not trying to take any jabs here, just trying to find the
Right.
logic behind why you stop paying Social Security after that
I
much.
think originally there's some actuarial work that goes into determining how much money needs to be in that plan. You're right though, it's not necessarily in the spirit of the way a lot of the tax code works. And there are a lot of things that don't quite jive with what you might expect. A lot of it does sort of follow a certain core set of principles of what should be able to be deductible, what should be taxable, and what shouldn't. But there's always, it's a man made system. It's just really a rule set at the end of the
Yep.
day. It's just a group of laws. So there are always items that, sort of go against what you might intuitively expect.
So on page 2, is there anything we haven't covered?
Basically, the rest of what we see here are the pre-tax deductions, like your 401k contribution,
Okay.
the dental and health plans here. So when you see pre-tax deductions, that means they're taking it out before they assess your tax.
So
So
it's a
this
benefit.
it's a benefit. That's why financial advisors and CPAs like myself will encourage you to fund your 401k plan. It's a great tax saving tool, and you're funding your retirement plan. It's a win-win. And it's nice that in a lot of cases, the health insurance is also pre tax since we get horrible medical deductions available to us. There's not a lot of relief for people who have a lot of medical expenses. It's nice
Nope.
that at least, if you're lucky enough, your premiums are paid with tax free dollars.
Okay.
And that's pretty much the bulk of this. The rest of this, I mean, this person, I guess, has been eating at the cafeteria and there's some charges coming out for that. But those are really the basic items that you're going to see on most pay
So to
stubs.
recap, on this pay stub, we see a segment for income where there's a breakdown of what our income is like, the rates and the hours. We also see a segment where there is taxes and that have come out, as
Mhm.
well as anything that is pre-tax info. So if I'm making
Yep.
$100,000 and my insurance costs $10,000 a year for me, I'm only going to be paying my actual income, taxable income rate is going to be 90,000, not 100,000 because of that,
Correct.
correct? Okay.
Correct.
So I'm going to give you a rapid fire list of
Okay.
questions. And really, these are just terms that I'm hoping you can explain for the
Okay.
world. So, shortest form possible. There's, I think, 13 letters or so here.
Okay. I'm
Dub-
ready.
I,
I feel like, do we need like a timer or do I win a prize?
I think if this was like a game show, we could just
I'm
change
getting
the
into the
screen to a
spirit.
timer
Yeah.
and have you ding when you get them right.
Like the Jeopardy song or
Well,
something.
we'll see
Anyway.
how you do.
Okay. I'm ready.
First one, W-2.
So W-2 is what you get at the end of the year. It reports your income. It reports your tax withholding. It reports a lot of other stuff, but if you're an employee, you receive this at the end of the year and you need it for your tax return.
So when your accountant says, I need a W-2, that is the little sheet that tells you a summary of all the income you've made.
Correct. And you'll usually get it at the end of January, early February, depending on when your company has it ready.
What is a 1099?
A 1099 can be a lot of different things. I think it's most often thought of if you work as a contractor,
Okay.
you receive a 1099 miscellaneous instead of a W-2.
Okay.
And there's no tax withholdings and there's no FICA payments. And it's just, I said, I'm going to pay you $10,000. Here's a 1099 that shows I paid you $10,000 and that's it.
And so the tax burden is on the contractor.
Correct.
Fully, in full.
Correct.
Okay.
1099 can also mean interest and dividend statements, brokerage statements. Those are all sort of considered to be different kinds of 1099s.
So income outside of a paycheck, basically,
Yes.
for most part.
Yes.
A W-4.
W-4 is what you fill out when you start the job. You tell them how many allowances or exemptions you want to take. They have you do that little worksheet. This is really important. I want everyone to understand. The worksheet is a guide. You are not required to take the amount of exemptions the worksheet leads you to. It's a tool, but you can take however many or few exemptions as you want. The smaller the amount of exemptions you take, for example, if you claim 0 or 1 exemptions or allowances, those terms can be a little bit interchangeable. They're going to withhold the most amount according to their IRS tables.
So the lower the number, the most is going to be withheld. So meaning
Right.
the more money is going to be taken from your check, which means less of a risk of
Right.
owing money at tax season.
Correct. So if you're a person who really wants to make sure that you're getting a refund, you want to make sure that you're not claiming a bunch of allowances on that withholding form. Now, you do it when you start a job, but you can also redo it at any time during the year. You just need to fill out a new one and give it to whoever does payroll at your company if you ever want to adjust it.
Speaking of those two terms, what is an allowance?
An allowance in this case means one of those numbers. So the worksheet that it takes you through asks you questions like, does your spouse work? And if so, take one allowance for that. Do you have a dependent child? Take an allowance for each dependent child you have. So if you're particularly someone with a lot of children, you can easily get to, taking 5 or 6 allowances on that W-4. And that means they're going to withhold the least amount they need to withhold because they're assuming that you need the money in your pocket to feed your 5 children. Does that make sense?
So
So,
could another term in a different world for an allowance be a point? Like it's
yeah, yeah,
like if you have 5 points, we're gonna deduct, this much versus is it just a fancy tax term for that
yeah,
basically?
pretty much, yeah.
Okay. What's an exemption?
Very similar. I mean, in technical terms, an exemption refers to what we used to be able to take on our taxes called a personal exemption, which was basically a dollar amount you got to deduct for everyone reported on the tax return, you, your spouse, any dependents. That's gone now in the 2018 tax reform, but it's used really for any income that's being excluded from your taxable
So
income.
it's kind of like we're gonna give you a break
Yeah.
if you're one of these things would be an
Yes.
exemption.
Yes.
What is a standard and itemized deduction?
So every taxpayer takes one or the other, either standard or itemized. The standard deduction is a flat amount. It's based on your filing status.
Okay.
So if you're single, it's a certain amount. If you're married, it's about double that. Um, Works similar to the way a personal exemption would and doesn't make you track anything like your mortgage interest or your medical expenses or
So
your
it's
charitable
basically
giving.
like, hey, we're agreeing, we're gonna get this done easy and smooth. You
It's a
can take
freebie,
the
basically.
okay.
Yeah, it's basically a freebie. The itemized deductions can be more beneficial if you have more itemized deductions than your standard deduction amount that is granted to you.
Okay.
So often the tipping point for that is homeownership because of the mortgage interest. That's an itemized deduction, and that can sometimes tip you over the standard amount, and it's suddenly more beneficial for you to itemize your deductions. The other things that fall into that category are medical expenses, although the deduction is, can I say shitty? It's a shitty deduction for
Yes, you
medical
can.
expenses. It's a horrible deduction. You have to have a massive amount of medical expenses to even qualify for it. Um, Real estate taxes, taxes paid to states and localities, although that again, that has been cut severely under the new tax reform for 2018. That's now limited to $10,000. Taxpayers, here in the Midwest, that's not such a big deal for, but if you live in a more expensive part of the country, if you're on the coast, you're in California, you're in New York, you're paying really high state taxes, your real estate taxes are super high. That's hurting a lot of people this year in the reform that's now very limited. Also, charitable giving, investment interest. There used to be, again, this is gone in the new reform, a miscellaneous category that included things like your tax prep fees, any out of pocket employment expenses that you don't get reimbursed for, investment management fees, all these kind of items. That whole category has now been removed.
Okay.
But at the end of the day, if your itemized deductions are more than the standard deduction, which for this year for a married couple is $24,000, they raised it a lot
Okay.
in the new reform. So even if you itemized in the past, you may take a standard deduction this year because they've raised it up so high. But basically, you take one or the other. You don't take both.
What is earned income?
Earned income is income you got from working, whether that was working for somebody else or working for yourself. It was generated by you actually showing up every day and doing something, as opposed to investment or what we call passive income, which is generated without you really having to do anything. Either your portfolio is growing or maybe you're a landlord, something like that. Typically, that income is not considered earned.
What is a W-9?
A W-9 is a form that, again, an employer or if you're a consultant, a client may ask you to fill out. All it is really your name, your address. If you have a business name, your business name, and your tax ID. So generally your social security number, or if you have your own LLC or small business, you may have an EIN and you would put that on there. It's really a form you give to anyone who's going to be issuing you a tax document.
Okay.
just so they have all your information
So,
correct.
from my understanding on something like a W-9, or any time an employer or someone that's going to give you money asks you to fill out a government form, it's
Mhm.
because either A, they're required by law to do such thing, or B, they're going to have to report the income that they provided you. So, if it's something that you're not going to report the income because you just think,
Yeah.
you're a consultant or whatnot, well, it's going to get reported through the people that paid you. Is that right?
Correct. And I think that's something that's really important for people to understand. Any tax document that you get, whether it's from your employer, your brokerage house, whatever it is, if it's one of these official forms we're talking about, it's a W 2, it's a 1099, it's a K 1. I know we haven't gotten there yet. The IRS also gets a copy of that. Okay. So you get yours in the mail, but your employer or whoever has also given the exact same thing to the IRS. So to some extent, they have an expectation as to what you should be reporting. And if you don't report what they have on their end, you will hear from them about it
Absolutely.
eventually. Again, they're understaffed, but there's a lot of automation to that process where they can just line you up by social security number and see, okay, what items do we expect to be there? And if they're not, they'll ask you about it.
What is a K-1?
So a K-1 you can receive from a multitude of different types of entities. If you are an owner in a small business like a partnership or that maybe pays taxes in S corp, I don't want to get too far down that route, but that's how your earnings are reported is from a K-1. So the business files a tax return.
So, rather than a W-2,
Right.
if I own an LLC, I'm gonna get a K-1.
Well, if you own an LLC with other people, right?
Okay.
If you yourself are just the only person in the business, you can report that on your individual income tax return without having to deal with a K-1 or a separate filing.
Okay.
But if you're in business with other people, you're for sure going to have a separate business filing, and that business return will include K-1s to any owner in the company that shows their share of the company's income for that year. The same thing is also true of trusts. If you're the beneficiary of a trust, you'll receive a K-1 at the end of the year reporting your share of the trust's income.
Okay. What is a credit versus a debit? I always get this mixed upside down because it seems counterintuitive when it comes to accounting.
It is. As an accounting term, it's very counterintuitive. Without getting too boring and technical about accounting entries, there's two sides to every entry. They have to balance. One side is called a debit, one side is called a credit. It doesn't necessarily mean a debit doesn't mean money's going down necessarily, and a credit doesn't necessarily mean money's going up. It's just part of the double entry accounting system that debits are on the left and credits are on the right. So it's not as intuitive.
I've got two more terms, but I want to ask you to get super nerdy for me.
Oh, done.
Where did modern accounting start?
Oh my God, I have no idea. Are you kidding? I don't
Dang it.
know.
I thought you'd be like, well, in the 3000 BC, an abacus was made,
I mean,
and that's our modern accounting
I
system.
can't tell you. So we have, like I said, a double entry system, which is two sides to every entry. There
Okay.
is such a thing as a triple entry system,
Okay.
but it hasn't caught on, shockingly.
I
But
hope
someone
not.
did come up with that. I don't even want to know how that works, but sorry.
So, what is adjusted gross income?
Adjusted gross income, you'll probably hear referred to as your AGI. It's really a technical term from your tax return, and it's your gross income. So, all your different kinds of income that you may have earned throughout the year, minus a few really preferential items that we call above the line deductions. That's your AGI. Your AGI is important because a lot of other things on the tax return are calculated based on that figure, particularly your state taxes. They're all calculated a little differently, but most of them start with that AGI number.
Marginal tax rate.
So we have a marginal tax rate system. And what that means is just because you are in a certain bracket, say you're in the 25% bracket, you are not paying a 25% rate on all of your income. Everyone gets the benefits of those lower tax rates. So you fill up each bucket and pay that minimal tax rate until you hit the next bucket, and then you start paying the next tax rate. So to make it a super easy example, let's say the tax rate changes at $100,000. Let's say below $100,000 it's 20%, and above $100,000 it's 25%. These are not the real numbers. I'm just trying to use a easy example. And let's say you made $110,000. The first 100,000 is in the 20% bucket, so you're going to pay 20% on that. You're only going to pay 25% on that next 10, that $10,000 you made over 100. So this is something that's really preferential to the taxpayer, and it's why your effective rate, meaning sort of the average rate of tax you pay on all of your income, is usually much lower than the tax bracket you're actually in.
So to recap what you're telling me, if I made $100,000 and let's say there's 15, 20, and 25 tax bracket of if I made $50,000, and again, I don't know if these are accurate, but if I made $50,000, I'm going to be paying the 20%. And if I made $30,000, I'd be paying the 15%. So rather than me thinking in my mind, I make $100,000, I'm in the 25% tax bracket, I'm going to owe 25 grand this year. It doesn't work that way.
Right.
You're only paying in the chunks at that tax bracket. So as you go to
Right.
the next bracket, you only
Right.
pay in those blocks.
Exactly. So you don't miss out on those lower tax rates. You just pay more on the income that exceeds them.
Gotcha. Does the state work the same way?
It does. Yes.
That's
Although
handy.
usually the state brackets, state taxes are a lot lower, generally speaking, than federal tax rates. Most of us pay on an average effective rate around 20% in taxes, income taxes. State taxes are a lot lower, anywhere from 4, 5, 6, 7, 8%. Some of the higher states are up to 12%. New York, California, you
I
can
had to
even reach
Google that
13.
while you're bringing that up
Yeah.
because Kansas, I believe, is 8%.
I think it's lower than that. Did you Google it?
7, 8%. I'll have to look that up.
But there are sometimes brackets for the states, but because the numbers are smaller, they're a lot more compressed.
The number one is California, 13.3%.
Yeah. California is extremely tax aggressive.
So when my Cali friends always complain about state taxes, they weren't lying.
No, they're not lying.
Which surprisingly, number 2 on this list is Hawaii, which I can understand why. I mean,
Yeah.
they've got their own little ecosystem they need to.
Well, and logistically, it's difficult to live in Hawaii. They're just so removed from everything. That's
May
why a gallon
logistically
of
be
milk
bad,
costs $10.
but
there.
I bet it is pretty pleasant.
Oh, it's nice.
If
Have you
can-
been?
I have been to Hawaii, yes. I don't know if I'd want to live there, though, when you think about it.
I mean, I would love to live there. I wouldn't like being quite so far away from everybody. I mean, you can't just on a whim come home for the weekend.
You were literally in the middle of the ocean,
Yeah.
away from everybody
Yeah.
else.
Yeah.
Do taxes always need to be filed on April 15th?
You can get an extension if you need one.
I think most people don't know that, right? Like
Right.
if you got some life stuff going down and you
Right.
need an extension, that is a valid thing you can do.
Absolutely. You need to file for it. You need to tell the government that you need an extension. And what a lot of people don't understand about the extension process is even though you get 6 months of an extension. So if your return was due April 15th, once you have an extension, you're clear until October 15th
Okay.
to get the returns filed. The extension is just for filing the returns. Technically, any money you owe still has to be paid by April 15th or the tax deadline. You know, they've been weird the last couple of years because of federal holidays. But if you owe, you're supposed to pay it then. If you wait to pay it, it's not a huge deal, but you'll be charged interest and penalties.
Which is pretty nominal, but
Exactly.
if you need the time to get your stuff together, it's
Exactly.
plausible.
Exactly.
So I got a list of a bunch of questions here that are as close to yes or no as possible with some
Okay.
short explanations.
Okay.
Is it necessary to file a tax return?
For most of us, if your income is really low, less than $10,000, you're not technically required. In a lot of cases, you still want to file, though, especially if you're owed a refund. That's the only way to get it. But you're not technically required to unless your income exceeds that amount, and some other caveats. But that's the general rule.
At what age do I have to start paying income taxes?
There's no age. It's all about when you start making money.
Is there anything I don't have to pay taxes on? Like some money
Yeah.
coming in?
Yeah. Municipal bonds are generally tax-free. Life insurance payouts are tax-free. Gifts are tax-free to the recipient. It's possible the person that gave you the gift might owe some taxes on it,
Of up
but
to
that's
how
unusual. We get a lot of free gifts right now.
Okay.
These are rules that change frequently. The estate rules we've seen them change a lot, just even in the last 10 years. Right now, there's a yearly amount you can gift anyone, which is it might be $15,000 now. So I can give you $14,000.
That would be great
Yeah, I would.
Appreciate
I
it.
wish I could.
in many ways.
In many ways. That's a totally tax-free transaction. You don't owe tax. I don't owe tax. I don't have to file a gift tax return.
Okay.
If I were to give you $100,000, that's in excess of that annual amount. I would then need to file a gift tax return. I still wouldn't owe any tax though, because in addition to that annual cap of 15,000, we get a lifetime cap that right now is over $5 million for a single person, and over 10 if you're married. So you have to do a lot of giving before you're actually paying gift taxes. But there can sometimes be a filing requirement. And like I said, it's always on the person who gave the gift. If
Okay.
you received it, you're free of taxes.
Is it okay to file my own taxes?
Yeah. I mean, depending on your situation. If you are, a W 2 employee, you're making a modest amount of money, you're a single person, you don't have anything else to report on your taxes. No, there's nothing wrong with it. Of course, as complexity accelerates, you're better off with some help.
Is it smart to file early if I can?
If you can, yes, for a lot of reasons, mostly because you'll get your refund a lot faster.
Speaking of that, should I always be getting a refund?
Depends on how you like to feel on tax day. So
I've been depressed on tax day my entire life. So
there's no right or wrong reason or right or wrong answer to that. Rather, some people really want and like the feeling of getting a refund, and there's nothing wrong with that. Some people feel like they're giving the government an interest-free loan, so they would rather hold on to their money and owe and write a check at the end of the year. And then there are folks who try to come out and just break even as closely as they can, which is really difficult to do.
but it's something to consider that a refund means that you've overpaid and you're getting your money back. It isn't the
Correct.
government saying, "Great job, guys. Here's some extra money."
For the most part, yes. There are some credits that are called refundable credits, which means the government's going to pay you that money no matter what. So child tax credits are partially refundable. So that is actually money that the government's giving you. But other than that, yeah, you're right. It's you've withheld more than you needed to withhold.
Does my
Generally,
tax situation change if I get married and or if I have kids?
yes to both.
Great. Shortest answer that we've had on here. Yes,
They're
it
not
does
simple questions.
change.
Yes, it changes.
Do I pay a different tax rate if I freelance on the side?
You don't pay a different rate, but it happens differently. So I mentioned before when we talked about FICA that half is paid by the employer and half is paid by you, the employee. When you're self-employed, you're both the employer and the employee. So you pay both halves of that, and that's what we call self-employment tax. Okay, so when you hear the term self-employment tax, it's really the same thing as payroll taxes. It's the exact same amount. It's going to the exact same place. It's still funding FICA. It's still funding Social Security and Medicare and unemployment, which we didn't really mention before, but federal and state unemployment programs. So it's the exact same amount. It's just you're not paying yourself a paycheck necessarily. So it's not being withheld all the time. So you end up paying it either through the year via estimated payments or all at the end on the tax return. They just calculate your total self employment tax and it gets tacked on.
Which is sometimes a hard pill to swallow for people who own their own business and haven't gotten to a certain size, or you're freelancing and doing something on the side. Is you've effectively got 15% that you've got to pay
Yep.
as a self-employment tax. A self-employment tax that the government says because you're not paying payroll taxes between you and your company, we're going to tax you 15%. And because it's called a self-employment tax, for many entrepreneurs, it feels like a penalty tax.
Right.
But it's not.
But it's not. It all comes out to be the same at the end of the day. And the reason I say that is because you also, as a self-employed person who's, you're just running your own small business, you get to deduct half of your self-employment taxes. So just the same as, if I worked for McDonald's and they were paying me a paycheck and they were paying half of my payroll taxes, half of my FICA and everything, they get to deduct that on their tax return. McDonald's does. So when you're your own boss, you still get to deduct the employer portion. So it's not a direct offset because it's just a deduction rather than a credit, which I
Sure.
can explain if you want. But it does help. So basically, you're not paying any higher tax than you would be really in any other situation. It just psychologically feels a lot different. And it also feels different because it's on your 1040 and nothing really offsets self-employment tax. Your income, your total gross income can be negative for the year. That's still not going to get you out of the self-employment taxes if you had self-employment earnings. Nothing really counters that tax. It's very difficult to get out of. You can't get out of it, basically. So that's the other thing I think that makes it feel like you're being penalized is that you have this huge chunk that just gets tacked onto that bill on your 1040 rather than on a paycheck. It's money you never saw and never had.
Let's talk audits. How often does a person get audited? Like, how many audits happen on a given basis? Is it usually personal or is it business? And then what happens if I get a notice from the IRS?
So audits, while scary and we should fear them, are extremely rare. Your chances of being audited as an individual are less than 1%. I think it's something like 0.6%. And again, that's like we talked about before. The IRS is understaffed, underfunded, don't have a lot of resources. So they just don't have the ability to audit a lot of people. It does tend to be individuals. Partnerships and S corps and other small businesses don't tend to get audited quite as much, though they are subject to audit and can be audited. The really strong candidates for audits are actually large corporations. I mean, like Fortune 500 companies, which makes up a really small amount of who is filing tax returns.
Okay.
But they have a 8 or 9% chance of being audited, which is a lot higher.
So, an audit specifically, an audit is when they determine they are going to get involved and relook at your
Mhm.
books versus getting a notice, which I think a lot of us may have gotten notices and we
Mhm.
feel a
Oh
lot of
yeah, people
anxiety by getting
panic.
a letter from the government saying, we think you're
People panic.
wrong. You owe me money.
Yes. Um, First of all, there are a lot of different types of audits. An audit can be a very small audit where they're only trying to verify 1 or 2 items on your tax return, which are usually pretty easy to resolve. Or it can go into a full examination research audit, which is we're going to look at every bank account you have. We're going to look at every loan you've ever taken out. We're going to look at everything and we're going to make sure that every dollar is accounted for here. That's a nightmare. But like I said, it's very unusual. The smaller notice or audits are easier to correct. You can get a notice for almost anything. So if you get a notice, my advice to you first is not to freak out. A lot of people really go from 0 to 10 once they
Yeah.
see that notice come in. Those notices are sent out and triggered automatically. So before we were talking about how the IRS gets a copy of everything you receive and they match them up. If something doesn't match up, say that they have a 1099 they were given that didn't get reported on your tax return for whatever reason, error, someone, whatever reason, mistake, they're going to send you a notice and they're going to calculate the tax on it and they're just going to ask you to pay it. Well, they calculate the tax in the least beneficial way possible to you, the taxpayer. They don't take into account if you have any deductions for it. They don't take into account, if you sold some stock or something, they may not take into account that you had basis on that stock. So they're over calculating the gain that you're
So,
paying
what do I
tax on.
do?
So what you do is you call an accountant and you have them look at it for you and they can help you respond to it and say, we received your notice. We agree with these portions of it. We don't agree with these portions of it. Here's how we feel it should be reported and the tax that we think should be due. And usually that process is fairly easy. Sometimes, the IRS is really a crapshoot, whether you're calling on the phone or corresponding by mail, which is what they tend to do. It kind of just depends on who picks up the phone, who opens that letter, what that revenue agent is like, and how much of a stickler they want to be.
What happens if I can't afford to pay my taxes? Is there like a standard payment plan or do they throw me in jail?
Not immediately. Actually, very few people go to jail over taxes. They save jail and criminal prosecution for people who are really purposely evading taxes on a high
Which
level.
I think is important to note because just because you got a notice saying, hey, we had this unreported income from this, they're not saying you've got a trial waiting and you're going to be in
No,
Leavenworth, right?
no. Which, and actually, let me back up and say something really quickly about the notices and really phishing scams. There are a lot of IRS phishing scams. So it's important for people to know the IRS is never going to call you on the phone. I've had so many clients call me in a panic because they received a phone call from someone claiming to be the IRS saying that there was a levy on their house and that the sheriff is on the way over to arrest them for
Doesn't
not,
work that way.
yeah, it doesn't work that way. They will never, ever call you. They will also never email you. So if you get an email that's claiming to be from a tax authority, it's spam, report it, delete it, don't interact with it at all. The IRS only communicates with taxpayers by mail. So you should be, if you're getting a real communication from the IRS, it's going to come to you in the mail and it's going to say IRS at the top. It's going to have the closest office address. We have an IRS office here in Kansas City. So
Which, fun footnote,
yeah.
now the IRS has small micro offices all over the
Hmm.
United States that if you can't afford to call an accountant
Hmm.
or you just need to ask a question directly to the IRS,
Hmm.
they have locations you can go into that are surprisingly not busy. This isn't
Yeah.
like the DMV, and
Yeah.
you can get real answers pretty quick.
Yes. They also have phone service that does the same thing. The hold times can be ridiculous, but that option is there. There's also something called taxpayer advocate services. It's a branch of the IRS, but it operates independently and it's really there to fight for the taxpayer. So if you get caught up in something really ugly, you're not sure how to handle it, the IRS isn't being responsive to you. That's another avenue you can go down and have an advocate who's on the inside who can sort of expedite things for you and help you get them resolved.
So if government says I owe $10,000 and I don't have it, what's the payment structure like? Because from my understanding, they now have a pretty standard structure for it's like, well, if you can't pay, this is what you
Right.
do.
There are payment plans available. Whether or not a payment plan is your best option is going to depend on the situation because the way the payment plans work, they cost money, first of all. There's usually a setup fee, and they're not long term. And the longer the payment plan stretches out, the higher the fees and the rates are. And that starts early. So even past 120 days, which is not a ton of time if you need to come up with a lot of money, just the fees on a payment plan like that can be several $100s. So it's there for you. And you always want to be upfront with the IRS and communicating with them and letting them know your intentions, but a payment plan may not be your best option. You can also do things like you can pay your tax bill with a credit card. You'll pay a fee for doing that as well. It depends on what service you use to do that. But sometimes that's a better option if you don't have the cash in hand because you have a longer time to repay it and you're dealing with the credit card company on that instead of the IRS.
What's the smartest thing I can do in order to ensure I don't pay too much in taxes?
The smartest thing you can do is work with a professional and you need to do it ahead of time. If you come to a really any financial professional, but a CPA specifically for tax advice, and you need help with 2008 and you don't come talk to me until February 2019, I mean, I can file your tax return, but I can't help you avoid any taxes that maybe could have been mitigated if we'd talked sooner. So, this is really the time of year that you want to be seeking out that guidance and professional help because there's still time left within the tax year to do things strategically or just to give you a heads up on what's coming. There's not always a solution, but at the very least, you'll know what is in store for you and you can plan accordingly.
Are business taxes harder than personal taxes?
Depends on the business, depends on the person is, probably the most straightforward answer. But there's just a lot. It's a different area. It's a different expertise depending on what size of business we're talking about. Small to medium businesses um, are fairly straightforward. The larger the entity, the more complex and nuanced it can become. And by industry, it can become more complex and more nuanced.
What do you wish could change about taxes?
I think, a lot of the tax code is surprisingly fair and a lot of it's really intentioned to help the taxpayer. But there's a couple of areas in which there's really not the proper incentive or reward. We already talked about the medical deduction being crap, right? So, to elaborate on that, to receive a deduction for out of pocket medical expenses, those expenses have to exceed 10% of your income before you get any benefit from it. So if you're making $100,000 a year, again, just for easy math, you have to have paid more than $10,000 out of pocket in order to start receiving a benefit. So if I paid $2,000 or $10,001 in medical expenses, I get to deduct $1 in that situation.
Hmm.
So that's not a really beneficial deduction. And it's something that, I mean, medical expenses are so outrageous right now. It's something that I feel like the government should be assisting people with more. So I think that medical deduction should be boosted. I think that the child dependent care credit needs to be
Yes.
boosted. It's pretty pathetic And daycare is a very real and necessary expense for pretty much any working parent. And that credit gets whittled down to almost nothing. So you can be paying,
I think the average in America is about you can average it pretty close to about $1,000 a month per child.
yeah,
So if you have two children, it's $24,000 a year, and it's less than $5,000 maybe.
oh, way less. I mean, it gets phased out with income. So the higher income, the less you get. So I see clients routinely that are paying, 20, 30, $40,000 a year in daycare, and they get a credit of $200 on their tax return because of where their income is. So it's a very, and again, kind of not in the spirit of the rest of the tax code, which says an ordinary and necessary business expense, something you have to pay for in order to make money should be a deduction for you, and you shouldn't have to pay
Sure.
tax on that. This is in total, um, I don't want to say violation of that because it's not really a blanket law, but it's against that idea that they whittle this credit down so small when so much of us don't have a choice
Right,
and
like
have to pay for that in
in
order to
order for
work.
us to make money,
Right.
our children have to be in daycare.
Right.
And it's not like I mean, while there are luxury daycares, we're not talking like, we're not talking about like
No.
everybody's got $10,000 a month daycares, right? It's
Right.
pretty flat across the board.
Right. Right. Yeah, absolutely. And then, another area, there are a lot of education credits for college and things that help offset those costs. But again, compared to the expense of actually going to college, it's a small drop in the bucket what you get back on your taxes for things like that. So that's another area that I think needs to be boosted.
Do you feel like our tax rate is too high or too low? Or perfect?
Well, I think it's reasonable. I don't think it's extraordinarily high or extraordinarily low. I think it's somewhere in the middle. I think the real answer to that question is how much money does our government need? And I don't really know the answer to that. But that's, we have to remember that that's the goal of this whole system is to keep our government funded so that we have roads to drive on and police and fire and
There's a consistent argument amongst a certain class of people in the United States that say, well, Switzerland has a 0% income
Mhm.
tax rate, and these places have 0% income tax rates. From what you've told me, there's no way America could survive on losing 80% of its
Oh
revenue
no.
coming into
Mm-mm.
this.
Mm-mm.
And the other thing that I don't think many people recognize is that while certain countries may have a 0% specific income
Mhm.
tax rate on those people, they still pay property taxes that are
Yeah.
higher. They still have other methods of taxing that can
Right.
cover that.
Right. And it's a good example to compare that to is, some of the states don't charge any income tax, right? Nevada, Florida, they don't have an income tax at all. They make up for it in other ways. Nevada has tourism and sales tax that they make up with for that with. So the same is true of any country that doesn't have an income tax based system. It's coming from somewhere else. Uh, and I think it's important to remember that it is a income tax, not a wealth tax. So you only pay tax on income that is new to you each year. If you have, $10 million buried in your backyard, you don't pay tax on that year over year. It's not a wealth tax. It's not about how much you own or how much you have in your portfolio. It's about how much new income is created each year. And that's why sometimes people say, well, how come this rich person I know isn't paying anything in taxes? Well, their income is very different than their wealth.
What's the one thing that you would want the potential listeners of this show and the people watching this video to take away? Because I'm sure for a lot of people, this is a lot
Oh,
to
yeah.
process.
hmm
What's the one takeaway you want them to remember?
I think the main takeaway for us to remember is how big a role individual income taxes play in our personal finances. It's a huge chunk of our money that goes towards individual income taxes and the payroll taxes that we've discussed. Um, that's a lot coming out of your pocket. So I say that to some of us have this idea of, I just don't even want to think about it. I just don't even want to go there. I want to pretend like taxes aren't happening to me. It's more than you probably are spending on your mortgage is going towards taxes. So it's worth spending the time to get the help you need, the clarity that you need, and in many cases there are strategic opportunities available to you to keep your taxes as low as they can be, which is, I think, what everyone ultimately wants.
Well, I appreciate you coming on this show.
You are so welcome. It has just been my absolute pleasure.
And I appreciate you explaining it like I'm 5 on a topic that is, both difficult and painful, I think, for many of us.
And, let's be honest, just sexy as hell, right?
Debits, credits, ones, zeros. I mean, we're really in a strong category of enthusiasm here.
yeah.
So I appreciate you not making it boring as well, breaking that mold of a traditional accountant. So
I try.
thank you. I do appreciate it, and thank you very much for coming on the show.
Thanks for having me. I feel like a really cool celebrity person.
Well, that's
Being
good.
here
I'm
today.
glad you feel that way. On that note, thank you for listening.
Can you just explain it like I'm 5?